What's going on, everybody? Hey, my name is Logan Manzanares, and today I'm going to share with you my favorite insurance policy. And I promise you, it's nothing you've ever heard before. It's not health insurance. It is not car insurance. It's not home insurance. This insurance, it will save you, and it'll save your family, and it'll save your wealth forever. So if you want to learn more about what it is, let's go. Hey guys, if you're new here, my name is Logan Manzanares. I'm a real estate investor. I'm a husband, I'm a father, and I currently own $4.5 million in real estate. We have cash flow from our real estate that does well over 6 figures a year. We're on our journey right now to create over 100 units by the end of 2022. So if you want to be part of this journey and learn exactly about real estate and how we're going to do it and how you can too, subscribe, follow, let's go. All right, guys, so today we're going to talk about my favorite insurance policy. I'm telling you, like I said earlier, it's not home insurance, it's not health insurance, it's not car insurance, it's not any kind of insurance you ever heard before. But it has my most favorite insurance policy because what it's going to protect my wealth for the rest of my life, and hey, it can protect yours as well. So without further ado, my favorite insurance is called cash flow, right? This is the reason why I love real estate, is because of cash flow. Now, everyone always worries about timing the market, whether the market is going to go up, down, sideways. It doesn't really matter. And I'm going to tell you exactly why it doesn't matter to me and why cash flow is a thing that saves me regardless of the market crash, whether the market goes up, down, or sideways. So let's talk about an actual example, right? So like right now, the market is going up, I'm sure, as you know. And so people are so worried about timing the market, trying to buy it at the top, or if they buy it, what happens if it crashes? So let's actually do a prime example of exactly what it looks like when a market crashes. Okay, so let's say you buy a home. Let's say right now it's worth $500,000. Okay, and let's say the market crashes in the next year. So all of a sudden now that market goes down 10%, which is pretty general about what a market does when a market crashes. So 10% means that house is going to drop from 500,000 all the way down to 495,000. Let's just say it dropped down to 409,000. So now all of a sudden your house went down $10,000. Okay. Now, when you bought that $500,000 home, let's say it's a primary home. Let's say you put down 10%, so you put down $20,000. Okay, so now you put on, so your loan's actually $408,000, but now the home is worth $409,000, which means that you still have a 10% gap between what you owe on it versus what the house is worth. Okay, this is why the mortgage companies do this, by the way, right? Is they want a little bit of protection. They know that markets don't usually crash, more than 20%. Okay, most markets have never crashed more than 20%. So that's why they generally put down 20%. Or if you're doing a primary home, usually you can put down a little bit less, 10, 15% as well, right? So using this example, you still have equity, okay? You still have equity. Now, the reason why this is super important is that you're not upside down in your home, okay? Now, and depending on what your terms are, most people are going to lock in a rate at, let's say, at a 30-year rate. Now the market could be, again, it could be 2.5%, it could be 3%, it could be 3.5%, it could be 4%. It really just depends on a lot of factors, but irrelevant. As long as you're rocking fixed rate debt, it doesn't matter if the market goes up, down, or sideways, because in a year, guess what? Your interest rate is still going to be the same. Even when your mortgage and your home values go down, your mortgage doesn't change. So as long as you know that you can afford whatever that rate is, so let's say it's $2,000 a month, as long as you can continue to afford that $2,000 a month, like no one's going to come snatch your house up from you. Your house isn't going to be like all of a sudden they're going to ask you for the whole payment left on that house, right? So that's the thing to understand about getting a mortgage, is that as long as you do fixed rate debt, you're actually, you don't have to worry as much about the market crashing or going up and down. Now, let's say you own this as an investment property, okay? So now we use an example as a primary home, but let's say you own the same home as an investment property. And so again, your mortgage is $2,000 a month, and let's say you find a renter for $2,500 a month, okay? And so again, when the market goes down or it crashes, again, the value of the home, you're right, it does go down. It goes from 500,000 down to 490,000. But guess what? Your rents don't go down. They stay the same, right? And as much as people think that when market crashes, everything goes down, it's not the way it works. And generally what happens, and you actually can look at 2008, is that when markets crash, guess what happens? It means people go away from being able to buy homes, but they still got to live somewhere. So what happens? They become renters. And so what happens to the supply and demand of the rental market? That's right. The demand is down, supply is up, because all these people who were once homeowners now have to go into the rental market, and that puts pressure and puts demand on the rental market, which basically just pushes prices up. So if you're an investor and you see a market crash, well, guess what? Now instead of paying $2,500, instead of charging $2,500 a month for rent, now you might be able to charge $2,600 or $2,700, which increases your cash flow because your debt, your mortgage is fixed. It doesn't change whether the market goes up, down, or sideways. Okay, And so are you starting to see what I like? Are your wheels spinning yet? To start to see like it doesn't matter if the market goes up, down, or sideways, as long as you buy it right and you make sure that you can rent it for more than your mortgage is. Your mortgage is going to stay the same. The thing that's going to be able to adjust is rents. Okay, and if the market does crash, guess what? Rents go up. If the market goes up, guess what? Rents go up. So like the one thing that's always going to go up is just like rent, just like inflation. Like that's why inflation is tied to market rents. Just like how like you actually fear the cost of a pop that used to be 5 cents. You ever fear the cost of pop going down to 5 cents again? It's never going to happen, right? Just like you used to buy a car for a couple $100, right? That's never going to happen. It's the same thing with your rents. Like your rents are never going to be 5 cents. They're never going to be like $100, $200, or $500 a month ever again. And so as long as like inflation goes up again, like am I saying inflation is good or bad? It doesn't matter, right? I'm just saying that like if you think about it from a logical point of view, rents are not going to go down. So as long as you buy it properly with the right debt, fixed rate debt, don't buy adjustable rate mortgages, things like that. Make sure you're getting fixed debt. Like as long as you do that, like that is your best insurance policy against a crash. So at the end of the day, it does not matter if the market goes up, down, or sideways, as long as you buy it right. And again, whether you're an investor or whether you're a primary owner, if you're a primary owner, you should make sure that you can afford that payment regardless, right? It doesn't matter if the market goes up, down, or sideways. Like if you find a good deal that makes sense on paper, you know you can rent it out, or you know that you can afford to pay for that, then all of a sudden it doesn't really matter how much you actually pay for that home. It's not making sense, hopefully. And so that's your best insurance policy. And so that's why I'm currently buying lots of real estate. And you know what? When the market keeps going up, I'll continue to buy more real estate. I'll just make sure that it pencils out and that it cash flows. And you know, when the market goes down, well, it's actually going to become even better and even easier because all of a sudden the market prices go down. Guess what happens when you pay less for a home? Your mortgage rate goes down. But again, like I said earlier, rents continue to go up. So if you're a real estate investor, now instead of paying $2,000 in mortgage, let's say you got that home for $400,000, now you might be being able to pay $1,500 or $1,600, but your rent's still going to stay at that $2,500 or $2,600, $2,700. Now you're just going to have a bigger spread in your cash flow. And that's why cash flow is your best insurance policy, because as long as you don't have to sell. Now, let's move this to another example. Let's say that you have to sell the property for whatever reason. Like maybe you have a balloon payment. Again, another problem with if you have some sort of debt with a balloon payment, that's a problem as well. But if you have no need to sell the property, then you can wait through a correction or a depression, whatever it may be. Let's say you have to wait 10 years, right? So now all of a sudden it dropped from $409,000, $408,000, and then over the course of 10 years, it came back up to $550,000. Now you still have this equity because you held on to that home long enough, because either you had a renter to pay the whole time or you were able to pay the whole time. And now you have equity in that property because you were able to wait out the storm, because ultimately over time, like we all know that real estate does go up over time. Doesn't mean that it never goes down, right? There's always corrections, always ups and downs. But as long as you can weather the storm of a correction, of a downturn, of a depression, of a recession, then all of a sudden it doesn't really matter. So number one thing you can do, buy on cash flow. When you buy real estate on cash flow, like appreciation is just gambling, it's just guessing. So if you're buying a home in hopes that it's going to go up, that it has been over the last 5 or 6 years, guess what happens when all of a sudden it goes down? Yeah, you're screwed. You look dumb, you look silly. You got to give that house back, right? But if you buy on cash flow, guess what? All of a sudden you look awesome. You look amazing. You look like you're super smart because your home appreciated because you held the home for 5, 10, 15 years, when of course over the course of time it's just going to go up. But you can only do that if it cash flows today, which means that if the market goes down, it doesn't hurt you at all. It's just on paper that it looks like a loss. So that's my message for you today, is that's why I love cash flow. It is the best insurance policy ever. Better than health insurance, better than car insurance, better than home insurance, right? It is cash flow. It's your number one insurance that can help create your wealth, to build your wealth, and to give you peace of mind at night. So hey, without further ado, if you like this video, please let me know. Comment, like, subscribe, share this with your friends. And you know what? If you like it, come back for see some more. So my name is Logan Manzanares, and I'm out.